You hand your money to a bank and it immediately leaves. Not metaphorically, not slowly. It's gone. The moment your deposit hits the screen, the bank starts using it. Not storing it, not guarding it, using it. And once you see how, it becomes hard to unsee. Right now, trillions of dollars are sitting in bank accounts around the world. Savings, salaries, emergency funds, rent money. Most people think of that money as parked. It isn't. It's moving. It's multiplying. And sometimes, it's disappearing. This matters right now because interest rates are high, banks are under pressure, and trust in the financial system is quietly thinning. When banks wobble, people suddenly ask a question they rarely think about. What is my bank actually doing with my money? Let's walk through it slowly. You deposit $1,000 into your bank account. The app shows the balance. You feel safe. But the bank does not place your money in a vault with your name on it. That vault doesn't exist. Instead, your money becomes part of the bank's balance sheet. It's no longer your money in the way you think. Legally, it's a loan you've given the bank. You are the lender. The bank is the borrower. And just like any borrower, the bank plans to use that money to make more money. Here's the first quiet trick. The bank does not keep the full $1,000. It keeps a fraction. Maybe 10%. Sometimes less. The rest is lent out. To someone buying a car. To a business expanding a warehouse. To another bank overnight. To the government through bonds. Your money becomes someone else's debt. And this is where the system gets strange. That person who borrowed your money spends it. The money lands in another bank. That bank keeps a fraction and lends the rest again. The same original $1,000 now exists in multiple places at once. Not physically. Digitally. Legally. This is how money expands without being printed. Banks call this normal. Economists call it credit creation. Most people never hear about it. Now let's do the uncomfortable math. If the bank keeps 10%, your $1,000 allows roughly $9,000 of new loans to exist across the system. 9,000. From money that never physically appeared. This works beautifully when things are calm. People pay loans. Confidence stays high. Nobody asks questions. But the system has a hidden requirement. Trust. You trust the bank won't fail. The bank trusts borrowers will repay. Borrowers trust they'll keep their jobs. Markets trust everything at once. Break the chain anywhere, and tension appears. Here's the part banks don't advertise. Your money is not instantly available to everyone at the same time. If all depositors showed up tomorrow and asked for their money back, the bank could not deliver. Not because it's evil. Because it's mathematically impossible. The money has been lent. Locked into loans. Spread across years. Banks rely on a simple assumption. Most people won't ask for their money at the same time. Usually, they're right. Until they're not. When confidence cracks, speed matters. Withdrawals happen faster than loans can be repaid. Digital banking makes this worse. Panic travels at the speed of a tap. This is why banks fail suddenly, not slowly. One week everything looks fine. The next week, it's over. And here's the irony. The system is designed this way on purpose. If banks didn't lend deposits, economies would shrink. Businesses wouldn't grow. Mortgages wouldn't exist at scale. Your paycheck depends on someone else's loan. Stability requires risk. But risk hides well during good times. Now let's talk about what banks prioritize when they use your money. They don't just lend randomly. They look for safety first. Profit second. Liquidity third. That's why banks often prefer lending to governments instead of people. Government bonds are boring. Low return. But stable. Your savings might be funding public debt instead of local businesses. Or parked overnight in financial markets you've never heard of. Money doesn't sleep. Banks make sure of that. And while your savings earn you a small interest rate, the bank earns more by lending it out. That difference is the business model. Quiet. Legal. Massive. Now zoom out. When interest rates rise, loans become expensive. Borrowers struggle. Defaults increase. Banks tighten lending. Money creation slows. Economies cool. This is how central banks slow inflation without touching prices directly. They pull on the banking system. When rates fall, the opposite happens. Cheap loans. More lending. More money. More risk. The bank doesn't decide this alone. It reacts. And you, the depositor, are along for the ride. Your money is part of a system that amplifies decisions far above you. One last uncomfortable truth. Your bank balance is a promise, not a pile of cash. A promise backed by confidence, regulation, and government guarantees. Those guarantees exist because this system has failed before. Repeatedly. It survives not because it's perfect, but because we keep rebuilding it. So the next time you open your banking app and see that number, ask yourself something simple. If your money is always moving, if it's always being used, if it only works when everyone stays calm, what happens the day people stop believing the number on the screen is really there?